Are you a small business owner, or have you invested in property that's highly appreciated in value? Or maybe you have some kind of other asset that's highly appreciated in value and you want to offload it, you want to divest and get rid of it, but you're just worried about the amount of taxes that you're going to owe if you were to take that step. Well, we're going to talk about some strategies today that can help mitigate that for you. My name is Spencer Ford, CEO and wealth advisor with Conservative Financial Solutions, and also a certified financial plan professional. Let's get into today's video. So you have this large asset that you're getting ready to sell, but you're worried about the taxes that you're going to owe. And for our example, I'm just going to talk to you about a small business owner. So there's a small business owner, they're getting ready to sell their business, and when they sell their business, they're going to have a $2 million gain that they have to deal with, and it's most likely going to be in the form of capital gains tax. So let's look a little bit more closely at capital gains tax and how that works, and then talk about a strategy that we might be able to help mitigate the amount of capital gains tax that individual has to pay when they sell their business. So when it comes to capital gains tax, there's three brackets. There's a 0% bracket, a 15% bracket, and a 20% tax bracket. So if you are a single filer, that 0% tax bracket goes to $44,625. When you go above that, you pay 15% in capital gains tax. And if you go above $492, you're paying 20% in capital gains tax. If you're married filing joint, you get a little bit larger bracket to deal with. So that a 0% tax bracket goes up to $89,250, then you're in the 15, and then once you get past $553, you're in the 20% tax bracket. And so for our example today, we're just going to assume that our business owner, they are married filing joint, so they're subject to those higher brackets. But the other thing that you have to pay attention to is there's something called net investment income tax. So when your adjusted gross income on your tax return goes above $250,000, you may be subject to a 3.8% surcharge on top of what you're paying in capital gains tax. That's called the net investment income tax. So it probably won't apply to your business if you're active in your business, because it only applies to passive income. But if you sell your business and you have a stock portfolio where you had some capital gains, well, those capital gains as passive gains to you would actually be subject to that extra 3.8%. So you want to be aware of these caveats inside of the tax code. Now, again, I mentioned we're just going to assume in our example, someone who is married filing joint, they sold their business, and now they have this adjusted gross income of $2 million. And we're assuming no other income just for this example so we can keep it easy. So that $2 million of gain is absolutely going to push them into this 20% capital gains tax bracket. So if they recognize all of that in 1 year, that $2 million, that's going to push them all the way through that 20% capital gains tax bracket. And when you take into consideration the 0, the 15, the 20, they'll pay total tax of $423,029. But what if we could take that payment and spread it out over a 5-year period? Maybe we're able to place that business in a trust before that business owner sells it, and then we can do an installment sale where they can recognize that capital gains tax over time. And let's say we're able to do that, and over that 5-year period, we can pay it out over 5 years and keep them in the 15% capital gains bracket. If we're able to do that, then they're going to save, or they're going to pay a total tax of $244,510. And the tax savings that they would have is $178,519, or 42%, just because we were able to keep them out of that 20% capital gains bracket. So this is just a concept that I wanted to lay out, because if you don't know about it, then you could end up paying a lot more in taxes than what you have to. And there's other strategies as well. So the strategy that we just went over was just, hey, you have a small business, you have an investment property that you invested in and it's exploded in value. There's some opportunities with installment sales, but there's also other opportunities with exchanges like 1031 exchanges. There's charitable remainder trusts, other trusts, opportunity zones, things of that nature. So there's many things out there that you can do to mitigate your tax over time. So I just wanted to get this out. If you're a small business owner, if you have a highly appreciated asset like a piece of real property, then there's ways that we can help mitigate your tax liability. If you found this helpful, please hit subscribe. I'm Spencer Ford, and we'll see you in the next one.